Hey guys, welcome back to FX Market Replay. So what I'm doing in this channel is pretty simple. I'm going into TradingView, switching on replay mode, and basically rewinding the chart back in time. And then I'm just going to play it forward and show you exactly how smart money was moving at each step. You're going to see the order blocks form, the fair value gaps appear, the liquidity sweeps happen. And this is something I'm going to keep doing every single week. I'll come back here, pull up the chart, hit replay, and go through the pairs where SMC was clearly working last week, and just show you exactly what happened, where price swept liquidity, where it respected an order block, where a fair value gap got filled. Before we go any further, let's first understand how the market actually moves in the simplest way possible. If you look closely, you'll notice that price continues to create higher highs and higher lows. This is one of the clearest signs of a bullish market structure, where buyers consistently push the price to new highs while defending higher price levels on every pullback. Now this is where things start to get interesting. At this point, the market can go in either direction. Maybe buyers step in and push the price even higher. Maybe sellers take control and the market starts dropping. The truth is, we don't know yet. And we can also see that every swing high and every swing low becomes a liquidity area. As the market moves higher and lower, it continues building liquidity, and that's exactly how price naturally moves from one liquidity pool to another. Every new swing high and swing low attracts more traders. As more orders build up, those areas naturally become liquidity pools. So now if you look at this swing low right here, this is a liquidity area. Sell-side liquidity is sitting right below this level, and that means there are stop losses resting down there. And the market knows that. And this is our buy-side liquidity area. This is where liquidity builds above the highs, making it a common target for smart money before the market makes its next move, because that's where many buy stop orders, stop losses of short sellers, and breakout entries are placed. So now I'm just going to play the replay mode here in TradingView and let the chart play forward, and I want to see which side does price go first. Does it sweep the buy side or does it go after the sell side? So, as you can see, price has already swept the sell side liquidity. Now let's switch to a lower time frame and take a closer look at what happened after the sweep. A liquidity sweep alone isn't enough to enter a trade. The lower time frame helps confirm whether smart money is actually reversing the market or simply continuing the trend. That's why many SMC traders wait for lower time frame confirmation instead of entering immediately after the liquidity is taken. So guys, if you look at this now, you can see that same pattern, right? Lower highs and lower lows. It's the exact same thing, just playing out on the lower time frame now. Price has two possibilities here. It can either break the lower high and start changing the market structure, or it can break the lower low and continue the downtrend. We don't get to decide which one happens, but smart money does. Our job isn't to predict the market, it's to recognize their decision and enter only after the market reveals its direction. Now this is my lower high. If price manages to break above this level, it could start moving higher. The reason is simple, the sell-side liquidity has already been swept, and now the market may be preparing to shift its structure to the upside. And this line down here, that's my lower low. So here's how I'm looking at this. If price breaks above that upper line, my analysis is still valid, and I'm still looking for a move to the upside. But if price comes down and breaks lower low instead, that's it for me. Setup's invalid. I'm stepping aside and waiting for the next opportunity. The best way to learn smart money concepts is by observing how price behaves after liquidity is taken, not by memorizing patterns. Alright, let's turn on replay mode and see what price actually does. Will it confirm the bullish idea, or will it invalidate our setup? Let's watch. Okay, so here I can see that price broke above that upper level with just two long candles, and right there you can see the change of character has formed. So what was a bearish structure a moment ago has now shifted to bullish, and it happened pretty quickly. Now after this next candle, we can clearly see that the gap between these last two candles is a fair value gap. It still hasn't been filled. A fair value gap is created when price moves aggressively, leaving an imbalance between two candles. So right here, this is the fair value gap. You can see it pretty clearly between these two candles. That's the imbalance price left behind. And just below the fair value gap, we have our order block zone. This is the area where institutional buying is believed to have entered the market. From this zone, price pushed higher, broke above the lower high, and created a clear change of character. That's what makes this area worth paying attention to if price decides to retrace. And now with the fair value gap sitting just above it, this whole area is looking like a pretty solid confluence zone. An order block is often the origin of a strong impulsive move that breaks market structure. So taking an entry from this zone gives you a pretty good risk to reward. Now some traders place their orders from the middle of the imbalance, and some prefer to enter from the order blocks. But personally, I always try to take my entry from the beginning of the fair value gap. Now once our order is in place, there are only two possible outcomes. Either price reacts from this zone and moves toward our take profit target, or the setup fails, our stop loss gets hit, and the market continues moving lower. That's why having a predefined stop loss is just as important as having a take profit target. So now let me show you something interesting. I'm going to take a trade entry right here in replay mode, set my stop loss, set my take profit the way I planned it, make sure the risk is right, and then just hit play and see what actually happens. Alright, so right now I'm marking out my entry, my stop, and my take profit right here on the chart. Always mark all three levels, entry, stop loss, and take profit, before you enter a trade. Seeing the full picture on the chart removes emotion from the decision. Your risk-to-reward ratio should be at 1 to 2 on every setup. If the chart can't give you that, skip the trade. There's always another setup coming. Alright, my buy order is now in place on TradingView. Everything is set according to my trading plan. Now, let's turn on replay mode and see how the market responds. Will price respect our entry and move toward the target, or will the setup fail? Let's find out. As you can see, price has tapped our entry zone, so our buy order is now active. From here, there's nothing left to do except follow the plan. Let's continue the replay mode and see how price reacts from this area. Once a trade is triggered, avoid making emotional decisions. Let the market either validate or invalidate your original setup. And there we have it. Not long after price tapped our entry zone, buyers stepped in and pushed the market straight toward our target. As you can see, our take profit level has been hit, and the trade has played out exactly according to our plan. Guys, a successful trade isn't just about reaching the take profit, it's about following a well-defined trading plan from entry to exit. Consistently executing a proven strategy with proper risk management is far more important than the outcome of any single trade. So that's example 1. Price tapped the entry, moved straight to the take profit. Now, let's move on to the next setup and see how it plays out. Alright, we're now looking at a fresh Euros Canadian chart. Let's start analyzing the market structure and see if we can identify a high probability trading opportunity using our SMC approach. When switching to a new chart, always start by identifying the higher time frame trend and key swing points. Now, if we look at the higher time frame, we can clearly see that price has been respecting the market structure. It has been moving from one swing to another, creating a series of well-defined swing highs and swing lows. Alright, I've marked the most recent swing high as our buy-side liquidity and the most recent swing low as our sell-side liquidity. These are the two key liquidity levels on the higher time frame, and they'll serve as our main reference points as we continue the analysis. So, at this point, we have liquidity resting on both sides of the market. Price may continue higher and target the buy-side liquidity above, or it could move lower first and sweep the sell-side liquidity below. Right now, either scenario is possible. There's another possibility we need to keep in mind. Price may sweep the sell-side liquidity below the swing low, but that doesn't automatically mean the market will reverse. If sellers remain in control, price could continue moving lower even after taking that liquidity. That's why we always wait for confirmation instead of assuming a reversal after every liquidity sweep. Alright, after moving replay mode forward, we can clearly see that price has swept the sell-side liquidity below our lower low. Now pay close attention to this candle. Even though the wick pushed below the liquidity level, the candle body closed back inside the previous range, leaving only the wick outside. That's an important observation, and it's something we'll keep in mind as we continue analyzing the price action. So now I'm just going to drop down to the 15-minute time frame and have a look at what's going on there. The higher time frame has given me my levels. Now I want to see what the lower time frame structure looks like around those areas. On the 15-minute time frame, we can see that price has simply established its market structure. Now I'll mark the key structural levels we'll be watching. If price breaks above this lower high, it will confirm a bullish change of character. However, if price breaks below the current swing low, the bearish structure remains intact, making further downside continuation more likely. Let's continue replay mode and move the chart forward. Will we get a bullish change of character, or will the bearish trend continue? Let's find out. Now, as you can see, price has traded above the lower high, but only the wick managed to break the level. The candle body stayed below it and closed back inside the structure. Because of that, I don't consider this a valid structural break or a confirmed change of character. For me, a proper break requires a candle body close beyond the level. Alright, now we have the confirmation we've been waiting for. Price has finally closed above the lower high with a full candle body, making this a valid bullish change of character. This confirms that the short-term market structure has shifted, and buyers are now showing strength in the market. Now, take a look at this. We already have a fair value gap here, and another fair value gap was created as price confirmed the bullish change of character. When a fair value gap forms during a structural break, it usually indicates strong displacement and aggressive buying pressure. This suggests that larger market participants are actively driving price higher, which is why the market expands so aggressively instead of moving gradually. Now, let's identify our order block. Before the market made this strong bullish displacement, the last bearish candle became our bullish order block. So this is the order block zone we'll be focusing on. An order block becomes more significant when it's supported by a confirmed change of character, strong displacement, and a fair value gap. So look, I always try to take my entries from the most recent fair value gap or imbalance area. That's just how I do it. And now I want to show you right here on this chart whether price actually follows that or not. Now, for my take profit, I'll use the most recent swing high on the lower time frame. Of course, you can choose a different target based on your own trading plan, but I personally prefer targeting the most recent swing high because it often acts as a logical liquidity objective and provides a realistic target for the trade. As you can see, this setup gives me a risk-to-reward ratio of approximately 1:4. Personally, I'm comfortable taking trades with this kind of risk-to-reward because it provides a solid balance between the amount I'm risking and the potential reward if the setup plays out as expected. Now, it's time to enter the trade. I'll use TradingView's replay trade feature to execute my position. Then, we'll continue replay mode and see how price reacts to our setup and whether the market behaves as expected based on our analysis. So I've set my entry, stop loss, and take profit right here, and I'm risking 1% of my account on this one. Now it's just a matter of seeing whether price moves my way based on the risk to reward or goes against me. Alright, everything is set. Now let's trigger the buy order in replay mode and see what happens next. As you can see, our buy order has been triggered and price has retraced deeply into the zone. It came very close to our stop loss, but the trade remains valid since the stop loss is still intact. After coming very close to our stop loss, buyers stepped back in and price started moving higher once again. This is a great example of why patience is so important. Price has created another fair value gap here. This new imbalance was formed during the bullish move. So after waiting for a while, price finally came up and hit my profit target zone. So the trade worked out, just needed a bit of patience. My stop loss was missed by just a small margin. This trade took almost 9 hours and 30 minutes to actually hit the target, and I know for a lot of people that kind of wait can feel really tough, but honestly when you just let the trade run and trust your levels, the results speak for themselves. So, that's how I approach the market. I stay patient, wait for high-quality opportunities, and only enter when price reaches my area of interest. In my experience, waiting for setups around an order block or fair value gap can often provide a better risk-to-reward opportunity than chasing the market. Of course, no setup is guaranteed, but patience and discipline are key to long-term consistency. I regularly backtest my strategy, and I'll continue sharing those backtesting sessions and results with you in future videos. If you found this video helpful, don't forget to like, leave a comment, and subscribe to the channel so you don't miss the upcoming content. Thanks for watching, and I'll see you in the next video, guys.